Well, we've already talked about the fact that there are assets outside shares and properties, and of course, private credit is becoming a huge asset globally. AltX is giving Aussie wholesale investors access to property-backed loans, and to discuss more and explain how it works, AltX co-founder and co-CEO Nick Raphaely joins me now. Nick, great to have you with us. We hear a lot about higher yields in private credit. What are the main risks that people should understand here before investing?
Look, I think it's the same as making any investment. You need to understand fundamentally what you're investing in. So maybe just try and unpack what private real estate credit is. I guess in its simplest terms, an investor gets to do exactly what the bank does in making in making a loan to a borrower. So the way we describe it is, if you take a mortgage, the bank is giving you money. The bank registers a mortgage over your property. As a private credit investor, you also register the mortgage. The bank values the property before advancing the money. As the investor, you get the benefit of the valuation as well. The bank makes the borrower sign security documents. The investor does the same, make sure that the borrower is signing documents to ensure that they understand and will honour the covenants of the loan. There's a term to the loan, so the loan goes for a period of time, at the end of which the borrower needs to repay the capital. And personal guarantees, so the borrower is actually guaranteeing performance of the loan the same as they would if they borrowed money from the bank. So really, in its simplest form, you're taking a concept which is something quite well understood, a bank lending money to a borrower. But in the case of private credit, private capital or a private investor is stepping into the shoes of the bank and being the lender. So all the things that a bank would think about when they're considering what is a sensible and prudent loan, who they're lending to, what is the right level of exposure, what's the credit quality of the borrower, what are the specific covenants of the loan, when is the loan going to be repaid, how is the interest going to be collected, what happens if the borrower doesn't repay the interest. All those sorts of considerations is what a private real estate investor or a manager like AltX would be considering in advancing credit to a borrower and providing an investment product to an investor.
All right, Nick, so when an investor actually logs into the AltX platform, what kind of individual deals do they actually see?
So I might just unpack that because it's quite an interesting story. We started our business back in 2012, and we were out there talking to investors, and we were doing it the old-fashioned way. We'd find a deal, and then the borrower would need, say, $1 million, and then we would write up a document and go and meet with people that we knew, the proverbial friends and family, and try and persuade them to invest with us in the deal. We'd say maybe we're putting in $300,000 or $400,000, and we were trying to raise the balance from the investors. I think what we realized pretty quickly was that we kind of ran out of our network. Our network exhausted itself. The people that we went to, either they ran out of money or they ran out of the amount of money they were comfortable to give us. At the same time, what we were realizing when we were talking to investors was that people really loved the concept, they loved the product. Remember, we started our business in 2012, shortly after the GFC. So a lot of investors had been burnt in the GFC, investing in things they didn't properly understand. And here we came with a very, very simple proposition. We're lending money to a borrower secured by an asset. We provide the address of the asset, the valuation report of the asset. We're only lending a percentage of the asset, and the borrower is guaranteeing the performance of the loan. So they will repay. We can call on the borrower to repay if the value of the asset doesn't cover what's owed to us under the loan. What we found was, as I said, we ran out of people to speak to, but at the same time, we knew there were lots of people out there that would invest in this product if only we could get it in front of them. We used to talk in the office about the concept of democratizing the access. How do we take this product out to the people? So we sit in Bondi Junction, so we would talk about the tradie in Darwin and the farmer in Wagga and the dentist in Perth, etc., etc. How do we take the simple concept of a real estate-backed loan, a private credit opportunity, and put it in front of them? And the answer, obviously, was with technology. So we built the AltX platform so that we could write up a deal, present it on the platform. Investors come and get accredited one time, so they do their KYC, their onboarding. We make sure that they're fully compliant as wholesale investors with us. And then when there's a new deal, investors can literally log in, review the deal, understand the risks, download and read the valuation report. And then if they're comfortable, actually make the investment through the platform. So what the platform allows investors to do is what really allows thousands of investors every evening when we publish a deal to log in, review, and if they want to invest in the deal all in their own time, at their own convenience, digitally, on their phone, their iPad, or their computer. So it's really used the medium of technology to take what's quite a simple, old-fashioned investment and take it out to the people. As I said, we democratize the access.
And Nick, what sort of information is provided about each deal so investors can make a decision, particularly when they're looking about where do the property loans and the like come from?
Yeah, so that's a really good question. We try and keep it as simple as possible, and I think what's made the asset class successful. I mean, the growth has been phenomenal over the past decade or so, and I guess what's contributed to the success of AltX is that the loan and the investment is at the core a very, very simple thing. So I'll just give you an example. If there was an apartment in Ryde worth say $1 million, we would provide the investors with a valuation report. So this is an independently commissioned report by an arm's length valuer confirming the value of the asset at $1 million. As I said at the start, the same as what the bank would do. The bank would commission a valuation report. We do exactly the same. So to answer your question, the investor would get the valuation report valuing the property at $1 million. We would explain in our information memorandum and our disclosure that we are lending, let's say, $600,000 in this example, which would be fairly typical. So a 60% loan to valuation ratio. So asset worth $1 million, AltX loan 600,000. We would disclose the interest rate that's paid to the investor. So the investor would be getting, say, 7.5% or 8% interest per annum, paid monthly in arrears. We'd give some information about the borrower, who the person is, what their background is, what their credit scores are, to give the investor a flavor of who is actually borrowing the money. And importantly, we would outline the exit strategy. So if our loan is for a term of 12 months, we would explain to the prospective investor what the borrower's plan or intention is to repay the loan to AltX, so then the investors then get repaid at the end of the 12-month period. So we have a borrower, we have the security, we have the loan amount as a percentage of the security, and the ultimate exit strategy. It's quite a simple thing, and I think, as I said, what's made the asset class successful is that you don't need to be a financial person to actually understand what's going on. If you have a friend who's a valuer, you can call them up and ask them what they think. If your brother-in-law or sister-in-law happens to be a lawyer, you can give them the loan documents, they can read and understand them and explain them to you. You can log on and do a title search, and you can see that the entity that you invest in actually holds the first mortgage over the asset. It's really the simplicity of the concept, I think, which has made it very successful and contributed to the uptake amongst Australian wholesale investors.
So you discussed there about being paid at the end of the year. Is that when income is paid, or is it monthly, quarterly, and how reliable has it been so far?
So that's a really good question. So the capital is paid at the end of the loan. So let's maybe follow through the example of the apartment in Ryde. So if an investor invested in that deal, and let's say it started on the 1st of March 2025 and it ran for 12 months, then the investor would expect to get their capital back 12 months later on the 1st of March the following year, 2026. Now, we generally hold borrowers to a 3-month minimum term, after which they can pay back the capital without any penalty. So what that means is, if we start the loan in March, so March, April, May, if let's say in July or August, the borrower decided they wanted to pay the loan back early, the investor would get their capital back at that point. So we're saying to the investor, the target is for a year, but really beyond 3 months, it's up to the borrower when they want to pay back. If you think about it, no similar to if you have a home loan, if you receive a bonus or dividends, or if you get a windfall or an inheritance, you can pay back or pay down your home loan at any time, and the lender, in the case of the home loan, a bank, gets the capital back. In the case of our deals, the investors will get the capital back. So for the capital, say 12 months, minimum 3 months, but after that can be as and when the borrower pays back. In respect of the interest is paid monthly by the borrower, and investors receive their interest from AltX monthly in arrears. So it's typically on the 3rd business day after month end that investors get the interest. So if you invested in a deal, every month on the 3rd business day, you would receive 1/12 of the percentage of the interest. So if it was 8%, you'd receive 8% divided by 12 on, say, the 3rd business day of the month. And then sometime within the 12-month period, you would get your capital back. So an investor that picks the deal, they're really choosing a fixed term, or they're signing up to a fixed term, in this case 12 months, knowing that they will receive the interest on a monthly basis. Very, very similar to the same way that you pay a mortgage. Every month on a certain date, the bank direct debits an account and you pay back. You actually get to be the bank in many senses doing this. To your question, as in what can go wrong and might an investor not get paid? Well, absolutely. It's no different to if a borrower doesn't pay their mortgage, well, the bank hasn't collected and the bank needs to make some phone calls and follow up with email and written correspondence and so forth to get the borrower to make the payment. So in our business, it would be the same. Typically, our borrowers pay, but sometimes they need to be reminded, or a follow-up needs to happen in order to ensure that the borrower actually does pay the interest. You're dealing with real people who've borrowed money, providing real assets as security, and our job as the manager is to make sure that we pick the right assets, we expose our investors and ourselves to the right amount as a percentage of the asset, that the interest rate is competitive and attractive to investors, and that as the manager, we make sure that the interest gets collected every month and the capital gets paid back at the end. Does that make sense?
It does. And Nick, what is the minimum investment to get started on the AltX platform?
So we at this stage are only available to what the law describes or defines as wholesale investors. And there are various ways in which one qualifies as a wholesale investor, which we don't need to unpack too much here. But in terms of the minimum, we typically say $50,000. So look, it's not a small check, but we're also not asking for $1 million licks. I guess the sort of people we're talking to and I guess who find the AltX offering attractive are able to make those sorts of commitments. What we typically say to new investors is just dip your toe in the water, because we're doing a lot of deals at AltX, and every day or every other day we're bringing a new deal to the investors. And so if I'm talking to a new investor, the way I like to position it is, try us out. We'll pitch the business, we'll pitch the offering, give us a try. If you like what you see, there'll be more to do. You can make further investments in new deals or top up what you have, et cetera, et cetera. If for whatever reason it's not quite what you think it is, then it's better for everybody that you're not in boots at all, because it's easier to sort of extract yourself. But I say things like, I'll tell you the interest gets paid every month. I want you to experience it for yourself. Make sure you call the office, we answer the phone. Make sure if you kind of ask amongst your network, people have heard of our business and had a good experience with us. So we like to give our investors the opportunity to get to know us, and our best and longest standing investors are the ones that have really grown with us and started small and really built up their exposure with AltX over time.
What protections, though, Nick, are in place if a borrower can't repay? So how does the security of that first mortgage work in practice?
So really, really good question. And I think it goes to the heart of why the asset class is attractive. And I think what attracted us to getting into it in the first place. So, okay, let's come back to my example of the property in Ride worth $1 million. If we've lent $600,000, we call that a loan to value ratio of 60%. So the loan as a percentage of the value is 60%. That's $600,000 on an asset worth $1 million. So if the borrower doesn't repay, we really have two forms of recourse. The first is to the and again, no different to the way banks operate in Australia, and the same recourse that a bank would have. So your first level of recourse is to the asset itself. As the first registered mortgagee, you have the first claim on the asset. So in the extreme event, if the borrower just disappeared and didn't pay you at all, there's a legal process to go through, but ultimately you would be able to repossess and sell that asset, very similar to the way a bank does. I pause to emphasize that practically this happens in a very, very minority of loan transactions that we and other lenders do, but the law is set up that way, and that is your ultimate security. You can repossess and sell the asset to recover the capital. So you're only trying to recover $600,000. You've got an asset with you valued at $1 million. You have a fair amount of coverage. You have, we call it the buffer or the headroom of $400,000, the difference between your exposure of 600 and the asset worth $1 million. So the first point is you have recourse to the asset. And the second is you have a personal guarantee from the person that has borrowed the money from you. So in our case, we would have checked out the borrower, assessed the creditworthiness and the credit strength of the borrower. And in the event that the value of the asset doesn't cover the loan, you can personally pursue the borrower, who has to make you whole from their own means. So you've kind of got two ways to get your capital back. The one is through the asset, and beyond the asset, you have effectively an unlimited commitment from the borrower to make you whole for the shortfall. So as long as you get the valuation right and you've sort of sensibly assessed the value of the asset, and you haven't lent too much money against the asset, and you understand the exit strategy, a lot of the risk is covered off. We always point out there is risk. Of course there's risk, because there's no return without risk. But what we like about the asset class, and I think part of the value that we add at AltX, is there's a number of risks we can control. So we would only lend 600 if the asset's worth $1 million. We would only loan to people that we're happy with, in terms of their credit strength and credit quality. We mitigate risks in those ways. So we think a lot of the risk is pretty well controlled in the asset class.
And how quickly do deals sort of fill up once they're listed on the platform?
Yeah, so that's a good question, and that's a function of how many deals we're writing versus how many investors we have. Over the decade plus we've been in business, there have been times when we've had, say, lots and lots of deals, and maybe not enough investors to take up the deals because, call it, our deal origination has run faster than our capital origination. Then there have been other times when quality deals have been harder to secure, but yet we've got a lot of investors that are calling us saying, guys, do you have more deals? So there'd be times when there's more capital than deals and times when there's more deals than capital. Practically, when we run the business, what we're saying to the loan originators is go find us loans as if there's unlimited capital. And what we say on the capital side is, guys, go and talk to investors as if there's unlimited loans. Obviously, there's always a limitation, but we have to sort of balance the two. I think the key point is we don't want to compromise the quality of the loan transactions we offer to investors. So we've got a lot of investors looking for deals, but we can't find deals at the right price and the right credit quality. We'd rather say to our investors, there's nothing available at the moment, let's talk again in a few weeks' time, than just be originating loans for the sake of it, because if you do bad loans, it can be terminal for the business.
All right, I've got some audience questions for you, Nick. James asks, will this be a mainstream portfolio strategy like adding bonds or ETFs to a portfolio?
Look, I think it's still evolving in Australia. When we started our business in 2012, we were kind of learning this on the run and leading with our own capital. When we went to investors and we said, come and join us on the deal, they would say, Nick, we like what you say and we respect the fact you're putting your own money in and you seem to be diligent in all the steps that you've taken. But there must be something wrong with the deal because the bank is not lending to the borrower. In other words, there must be hairs on the deal that you guys either not telling us about or haven't understood yourselves, because all the quality deals go to the bank. And I think people didn't really understand then the way they do now that a lot of strong creditworthy borrowers will look outside of the banking system if they need things that the bank is not necessarily the best at doing. So I'll give you an example. Speed. If a borrower wants to settle a loan quickly, they're less concerned about the interest rate that they pay. They're more concerned about actually getting the money in time. Paperwork might be something else. A bank may have 20 requirements that you need to satisfy in order to get the loan. And if you miss one of the 20, it's an outright no. If you're borrowing privately, the lender's probably a bit more commercial. They'd be, well, if we get substantially all the material and we can satisfy ourselves that we think that the loan is okay, we can see our way through maybe waiving a few of the requirements in order to get the loan done. So there's certain things that flexibility is another one. Certainty is something else. So you might go to the bank and they can't give you a deadline, they can't commit, they'll give you the capital. You go to a private lender, they may say, yep, we can lock in for next Tuesday, we will have your loan settled. People will pay more for that. So I guess I'm answering your question by saying what we've learned over time is that there are certain important aspects of the loan that the bank is not necessarily the best at doing, and that private capital is frankly better than the bank at doing. The bank will always win on price, but on other aspects, private capital will do well. So people say to me, how will AltX go in a rising rate environment, a falling rate environment, property markets going up, property markets going down? And my answer is actually like this: as long as private capital can offer things to borrowers that banks cannot do, there will be a role for private capital. So then, coming to your actual question about will this become a mainstream asset class? I think the answer is yes. And in Australia, it's sort of 10 to 15% of credit is provided privately. In Europe and the US, it's sort of closer to 50 or 60%. So if we look to overseas markets as an example, I think there's a lot more runway for private credit to become mainstream in Australia and to become a mainstream investment opportunity and an asset class for investors.
All right, Nick, Kim asks, if I pick one of these deals, how do I actually get my money back?
So when you invest in a deal, before you actually make the commitment and pick the deal, to use Kim's words, you have the opportunity to review the deal in its entirety, to read the valuation report, understand the risks, contact and speak to our team if you want to, and then you make the investment, and you're investing with other investors in what we call a special purpose vehicle, which then makes the loan to the borrower. As part of that structure, AltX is the manager of the loan. So our role is to raise the money from the investors, to pass that money on to the borrower. And then our role as the manager is to make sure that every month, as I explained earlier, the borrower makes their interest payments And then at the end of the term, the borrower actually pays the capital back. So the answer to Kim's question is you're relying on AltX. If you're investing with AltX, you're relying on AltX's its capability in actually not just advancing the capital, but collecting interest and getting the money back. And we've done over 3,000 loans in AltX. So we're always learning things, as all people in business are. But I think over 12, 13 years in business, through a range of different environments, both benign and adverse in terms of rates, markets, COVID, weather delays on projects, et cetera, I think we have a fair amount of experience as a manager in navigating the different market environments. But ultimately, you're trusting the manager that you work with to diligently manage the loan and collect the capital at the end. We often say to investors would say to us, well, have you ever had any workouts or defaults? Have any loans gone bad? And our answer is absolutely, loans have gone bad. That's not to say we've lost money for investors, because so far we have not lost money for investors, but we've had to work through loans, and we've had to, in rare occasions, enforce on loans and require that assets be sold in order to get capital back. What we say to investors, if a manager tells you they've never done that, they're probably being not entirely truthful, or they haven't been in business that long. So you want to make sure you're investing with someone that has both the capability and the resolve, not just to lend the money, but to get it back as well.